Good morning and welcome to today's webcast, New Lease Accounting Standards, Key Changes for Oil and Gas. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and Jake, I'll turn the line over to you to get us started.
Good morning, everyone. This is Jake Vossen with Moss Adams. I'm a partner here in the Denver office. I came over with the combination with Heinen Associates, and been working in the energy area since I first came out of college all the way back in the early 90s, and we're happy to be here today, and I'll let Matt Rolland introduce himself as well.
Thanks, Jake. My name is Matt Rolland. I'm also a partner here in our Denver office. I, too, came over with a combination of Heinen Associates with Moss Adams. I've been in energy for the last going on 15 years now, and glad to be here today.
And before we get started, I want to make sure everyone knows, feel free to type in any questions you have as we go along, and we've tried to set some time at the end to answer those questions, and we look forward to getting those sent in. So just a quick background on leases. Our thought here is we kind of go through 2 parts. We only have an hour, so this is a complex area where there's a lot of detail and a lot going on, but we would spend the first part of our presentation here going through the change to lease accounting rules and how that plays out, and show an example of it as well. And then on the second part of the webcast, we're going to talk some specific oil and gas implementation issues, regarding like drilling contracts and pipelines and the like, and we'll go from there. So currently, we account for leases. These are either as an operating lease or as a capital lease, and obviously, capital leases are on the balance sheet, and operating leases are just in the footnotes and off balance sheet. And this obviously created a lot of consternation among the FASB, who likes things to be as consistent as possible. And so, as we all know on this webcast, that leasing is one of the areas that resulted in the most structuring of transactions to try to get a desired outcome, either as a capital lease or more likely an operating lease over the years. And transactions that have very similar economic characteristics could have vastly different accounting consequences. And both the FASB and the IFRS really didn't like that, and so they have undertaken a long, arduous process of adopting this new standard, which gets all the leases on the balance sheet, whether they're operating or financing, and makes it much less likely to be able to structure a deal to get a desired accounting consequence. So there are some nuances in how things get recorded and presented. The vast majority of the desire to structure a transaction has been decreased. So this is effective upcoming here January 1 for calendar year-end public companies. So if you're a public company on this phone call, we'll ask some polling questions later on, but hopefully you at least started the process, have made some progress on it. If not, it's probably time to kick it into high gear. And for all of our private companies on the call, you get one more year to implement this standard. So there's times of the essence either way to really get going on this and start analyzing it. The third bullet here that says must be applied to comparative financials. From the time that I drafted these slides until today, in late March, the FASB gave a new practical expedient which would allow you to apply this only to the most recent financial statements presented and not have to go back and amend or recast the prior 2 years in your comparative financial statements as an option. That would include the footnotes only. So it can be applied to the earliest comparative financial period, or it can just be applied as of January 1, 2019. And obviously, anybody can already adopt the presentation. And Emily, I think that takes us to our first polling question, so I'll hand it over to you.
All right. Our first question is, which statement describes your company? And your options are private, less than 50 employees, private, greater than 50 employees, public, less than 50, or public, greater than 50. And I'll give everyone a few moments to make a selection. To participate in our polls today, please click the button next to the answer you choose and hit submit. Give everyone a few more moments. And let's take a look at the results. Back to you.
Okay, so it looks like we've got a pretty even split here between private and public. So that's good to know as you go about this. Like I said, the public companies, this is a little bit more urgent, and private companies, it's still time to really get started on this. So before I talk about exceptions here, I thought I just would tell you guys what the definition of a lease is underneath the new accounting standards as well. It's any contract or part of a contract that conveys the right to use an identified piece of property and equipment for a period of time in exchange for consideration. So that's a pretty generic definition and pretty all-encompassing. Some of the keys are you have to get substantially all the benefit out of using that asset, and you have to have the ability to direct the use of that asset over time. And the other key is it's an identified asset. So the text of the pronouncement itself gives an out for things like a portion of a pipeline, a capacity portion, unless you use almost all the capacity in that pipeline. So if you only have partial use of something or a portion of any asset, it won't count as a lease. So essentially, you have to have the benefit coming to you and the right to control that asset. If you have those two elements, it's likely a lease, and you have to account for it as such. They did give us some scope exceptions here. The The first one, lease of intangible assets, and the second one, lease to explore for minerals, oil, and natural gas. It's obviously very beneficial to us. If we had to go and put all of our oil and gas leases on the balance sheet, it would have been a very convoluted and very difficult thing to do, if not impossible. So we were lucky to get some relief in that realm. And obviously all oil and gas leases continue to be accounted for underneath historical FASB guidance or full cost guidance if you followed that with the SEC. So we do have some nice exceptions here that make this thing at least manageable or doable. But nonetheless, in our operations as oil and gas companies, we have a lot of assets that end up potentially being leases, including drilling contracts, compressors, pipelines, and things like that, right-of-ways, which we'll talk about towards the end. So even though we got a large-scale waiver on our main asset, we do have a lot of things we have to consider. All right, Matt, I think I'll turn it over to you to talk about the lease term and how that works.
All right. So getting into the lease term, so the ASC introduces the right of use model, which reflects that at the commencement date, the lessee is obligated to make payments for its right to use the asset during the lease term. And the lease commences on the date that a lessor makes the asset available for use by the lessee. Keep in mind there will be master lease agreements which may have multiple commencement dates, and that'll need to be considered. So the lease term begins on the commencement date, and now determining the length of the lease term depends on a few items. It's based on the non-cancelable term of the lease, and it includes periods under an option to extend if it's reasonably certain that it will extend. It includes periods covered by an option to terminate if it's reasonably certain not to be exercised. It also covers periods that are covered by an option to extend or not terminate that are at the discretion of the lessor. So that's non-cancelable. What's not on the slide is also need to consider cancelable leases. And this is really how the ASC and the FASB captures leases that were month-to-month or evergreen and the like, which largely would have been considered operating in the past and just expensed as paid. So after determining the non-cancelable period, company will need to determine the period for which the contract is enforceable. And keep in mind, it's no longer enforceable if both parties can terminate without any sort of substantial penalty. If there's a cancelable lease and only the lessee can terminate, it is considered to be an option and would be considered in determining the term up above and what the likelihood of exercising that option. If only the lessor can terminate, it gets included as part of the lease term when determining that. After determining a term, we're going to move into determining the lease classification. So for lessees, we're going to move from capital or operating leases into a finance or an operating lease. Really, we're going to determine if we have a finance lease, and this is required to be done at the commencement of the lease. So a finance lease is going to have one of the following items. It's going to have a transfer and ownership. So essentially, the asset gets released from the lease and transferred to the lessee at the end of the term. There may be a nominal payment, and consider the economic incentive in the transfer of that. Is it economic for the lessee to purchase this at the end or to receive title at the end? And this also goes into a bargain purchase option. Basically, what's the likelihood that that'll be executed? and this is assessed the same as the options to extend the term. The lease term is if the underlying asset's leased for a major part of the remaining economic life. Within the codification, it discusses 75% is considered a major part. Now, if you're at or near the end of the economic life upon commencement of a lease, then you wouldn't consider this. Lease payments. If the present value of the lease payments is equal to or greater than substantially all of the fair value, and substantially all is considered to be 90%. And then specialization of the asset. Is this asset so specialized that it's not expected to have any alternative use at the end of the term? Also consider, in order to repurpose the asset, would the lessor be expected to incur substantial costs?
And a few follow-up comments on that too. So the 75 and the 90% are in the appendix of the FASB. Unlike the prior rules, these are not necessarily a bright line. Under the old rules, if you could get 94% instead of 95% or 70% instead of 75%, you could get operating lease. And so while it's similar to the old rules, the rules are more judgmental, and these are just indicators of which lease it would be, a financing or an operating lease. So if you met all the other criteria and you were at 74% instead of 75%, you're probably in the financing lease.
Right.
And I also think in oil and gas, it would be unusual for us to have a specialized asset that has no alternative use at the end of the lease. Most wells, we can put stuff back in our yard and we can reuse it on a different well. We can reuse it in a different project or the like. I think this is more intended for industries where something gets custom built or custom designed and, can only make the widget that company sells or, or the like. I mean, I've tried to think of oil and gas examples of this, and I've seen some really novel, completion methods and technologies used and the like. But while that might be novel to that company or patented or whatever, to say it wouldn't have an alternative use at the end of its life, I think would be a stretch in our industry.
Yeah, those are all very good points. And it does highlight kind of the overarching goal that the FASB was looking to gain on this, is to kind of disallow companies from crafting leases in a way in order to determine the desired accounting outcome. So, So the next one, operating lease, and this is pretty easy. It's basically any lease that's not a finance lease. The wants.
So
I think
in the for the next step, once you figure out if you got an operating or financing lease, is to apply the appropriate accounting model, and we're going to go through that here in a second. So for all leases, whether they're operating or financing, we're going to record the lease liability, and we're going to record a right of use asset, which is a new asset that we had not previously recorded. The exception might be if you have a 12-month lease or shorter. You don't have to put that on your balance sheet. You can elect to continue to account for that as an operating lease. But I think you have to be real careful with that and make sure there's no purchase options or no extension and things like that. I think the risk of applying that and missing some kind of option in there could be greater than it's worth. And if you're going through all this work, you might think about whether you want to take that exemption or not. So, like I said, for all of these assets, we're going to set up the balance sheet the same way on day one, and then the accounting model will change as we go along. So the liability becomes just the present value of the future minimum lease payments, and we'll get to the discount rate here in a few slides to talk about what discount rate to use on that. And then the asset is similar. You start with the amount of the liability, and then you add into it any initial direct cost or subtract any incentives you received and the like. So essentially your liability plus your out-of-pocket cost to get that lease, that's what you end up capitalizing as the asset on your books. Okay, and Emily, it looks like we're ready for the next polling question.
All right, this is our second polling question. What is the status of your company's ASC 842 implementation project? Your options are talking about it, but not actually started, underway, population identified, analysis ongoing, new disclosures being drafted, or complete or nearly complete. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. This is our second question. Give everyone a few more moments, and let's take a look at the results. Back to you.
So good. So, it looks like we got a decent amount of the people. Hopefully, most of the private companies are the ones that are talking about it, but not actually started, and public companies on the phone, or at least in the underway or complete or nearly complete, 1.3% of you guys. So obviously that tells us all we got a lot of work to do ahead of us, and that's okay. We're kind of used to that as accountants, it seems like, the last couple of years. So, all right. So hopefully what I'd like to do here is give you guys an example, because I know a lot of people have gone to lease seminars and the revenue seminars, and everyone talks about the theory of this, but nobody actually walked through the debits and credits. And I'm an accountant's accountant, so I like to see how the entries actually flow through and work. And I hope you guys can look at this and understand a little bit better. So we have a typical lease here. I've simplified it in that there are no initial direct costs. I've ignored that component of it, nor any incentives, so that our liability or asset are going to be the same. But I kept something that was common, which would be a lease escalation over a number of years. So first year we had to pay $500,000, next year $515,000, and the third year $530,000. And I've also made it simple in the discounting that I've assumed it's an annual payment at the end of the period, just to make the math easier to use. So that's our lease that we have. And now the question is going to be, how do we account for this? So the discount rate, I'm assuming a 5% discount rate. The discount of that payment stream at $1,545,000 ends up being $1.4 million. And the straight line, if you straight line this rent, it would be $515,000. So straight line was what we would have done if this had been an operating lease before. And obviously, if it had been a financing lease, you would have put that $1.4 million on your balance sheet. So I think the one thing that's helpful to me when I first looked at this was, I think whether you're going to call this an operating lease or whether you're going to call it a financing lease, doing an amortization schedule or having an amortization schedule is important, because it allows the theory of how you're going to amortize the asset to make a lot more sense. So the first step is, either way, operating or financing lease, throw it into an amortization schedule and schedule it out like we've done here. So we see in the first year, if we were accounting for this as a liability, we're going to have interest that's higher, and then it's going to decrease as we make principal payments going out until to the end. And our last payment of $530,000 wipes out the liability and it goes away. Okay, moving on to the next screen here. And like I said, whether it's an operating lease or whether it's a financing lease, we're going to put the same lease liability on our books, and it's going to be the $1,401,145 in this case, the discounted value. And then obviously the right of use asset will be the same number plus those incremental direct costs we talked about before. Now what happens in year one, if you see here on the left, I have the journal entries for an operating lease, and on the right, I have the journal entries for a financing lease. And I suppose you can net some of these down on the operating lease if you wanted to, and have one debit the lease expense and 2 credits to the right of use assets and the lease obligation probably should have been consistent, called a lease liability there. But to me, it's easier to think about this as the same type of entry. So my goal if I'm an operating lease is that I get to record it similar to what I did before. So my expense on the P&L every year is going to be $515,000. So operating leases get straight line expense. Financing leases get accounted similar to the old capital lease, so treated like a debt. So how do I get the 515? Well, I know that I got to get that 70,000 off the amortization schedule that I created, whether it was an operating or financing lease. And so I'm going to debit my lease expense and increase the obligation for that 70,000. And then I know entry number 3, I got to pay 500,000. That's cash. Everyone knows that. That's easy. Take the cash out, reduce the liability by 500,000. And the FASB calls entry number 2 a balancing entry, which is a fancy word, I think, for plug. So you're going to push that number 2 entry, the 444,943, is whatever number you needed in order to equal 515,000 of straight line expense. So that's how you get the 515. Now the financing lease, you guys will all recognize, is very similar to the current capital lease. I'm going to record my interest expense. I'm going to depreciate the asset, and I'm assuming a straight line depreciation of the asset for the financing lease. And I'm going to reduce the liability with my cash payment. So you can see at the end of the day, if I have a financing lease, my total expense in red is $537,000, and if I call this an operating lease, my total expense is only $515,000. This is one of the major compromises that the FASB reached, and it's different than what the IFRS is. The IFRS really only has the financing lease presentation there. But if you think about, let's say, a 30-year office lease that maybe doesn't equal a financing lease because you're not taking up most of the useful life of the building, you're not taking up most of the fair value, and you're going to get out of it, on a long-term lease like that, you really could have accelerated the expense in the earlier years compared to what it would be had it been an operating lease. And thus the need for the FASB to allow both methodologies here. So we look at year 2, very similar, the $48,560. I'm just going to flip real quick back here so you guys can see that on the amortization schedule. The $48,560 in year 2 is interest. Let me go back to year 2 here. There's the $48,560 again. Now my cash is $515, like it was before. And I got to get my total expense to equal $515, so I balance it by reducing the asset by $446. And then similar financing lease as the previous year.
One typo on cash on the operating side. It says $515,100. That should just be $515 even.
Right.
Not to throw anyone off.
All right. Yeah. $100 at the end of the day to get that close. Everyone should be really happy. All right. So then moving on to year 3, once again, the $25,000 is coming off the amortization schedule. The $489 is what you're going to use to balance it, and you're once again end up with a $515 expense. And then, as you can see in the financing lease, are now we've flipped and we have lower expense in year 3. I think also on the cash flow statement, when you start looking at this, if you're doing an operating lease, all these cash flows, the $515, it's going to be in your operating cash flow. And if you do it as a financing lease, you're going to put the interest expense, in this case, year 3, $25,000 in the operating section, in the $530 in financing. So if you think about it, if anyone wants to structure anything, we used to try to see structuring where it wasn't a capital lease, and now I could see people trying to structure it to become a financing lease because of the more favorable presentation on the cash flow statement. This kind of shows how it all works in the end. So while we did plug that 449, the 466, and the 489, because we set up that amortization schedule, that ends up balancing it out to completely amortize that asset, the right of use asset, down to 0 at the end of the day. A couple points here that I like to mention is what happens if you have an impairment. And I'm sure most of you guys are thinking about that type of a question with oil and gas, being a primary component. This right of use asset is not, I don't think it's part of the oil and gas assets. We're going to talk about it earlier. If you have a drilling contract and you're their operator, it's going to go on almost every time gross for that. But, maybe you have this right of use asset for a drilling contract that you've put on there, and, prices have fallen, and we're in another down cycle. Everyone knock on wood that doesn't happen, but we know it will. And when that happens, maybe you want to, not actually use that rig that you've made a commitment for. Now you may not get the benefit out of it, so you're going to have an impairment. Well, you're more likely to have an impairment underneath an operating lease model than you are underneath the financing lease model, because you're taking less amortization early on. You're slow walking amortization and backloading it to the later years, so it increases the likelihood of an impairment. And then the impairment also kind of throws off all these journal entries that I've just described to you, because if you impair this right of use asset from that point to the end of the life of the right of use asset, you're going to straight line that amortization of the asset as opposed to using this balancing concept that we just talked about. So I think that's an important distinction to make, and I think this also is a chance to talk about debt covenants. And operating leases may be more likely to run into some trouble with your debt covenants. All these could change your debt covenants because we now have liabilities on our books that weren't there before. So you have debt to equity type covenants that you might need to talk to your banker about, coverage ratio, things like that. And then EBITDA type questions could be different between operating and financing lease, in that you have interest expense with the financing lease and you don't have that with an operating lease. So debt covenants are something that we need to consider in all this as well. All right, Matt, I'll turn it back over to you, and we can talk about discount rates.
Okay. So the discount rate, so in the example Jake used 5% as an exception. The requirement is to use the rate implicit in the lease if it's readily determinable. In many cases, if not the majority of cases, it won't necessarily be readily determinable. So an implicit rate is the rate which causes the aggregate present value of the lease payments and the residual value to the lessor to equal the sum of the fair value of the asset and any deferred initial direct costs of the lessor. So that last item there, any deferred initial direct costs of the lessor, will oftentimes not be known by the lessee, and therefore the implicit rate would be considered not readily determinable. So we'd expect to see most of the times these calculations using the incremental borrowing rate. And the definition of that is the rate that a lessee would have had to pay to borrow on a collateralized basis over a similar term and amount equal to lease payments. And it's on a collateralized basis, and the key here is that it's not over collateralized. Therefore, this isn't really a risk-free rate. Now the difference is, depending upon what rates are doing, maybe nominal, but that's a key component. And in rare cases, if a company is unable to obtain financing due to its financial condition, they would likely use the lowest grade of debt currently available as their rate.
And there is a private company expedient that would allow private companies to use the risk-free rate for a term similar to the length of the lease. But remember, if you chose that, you're going to end up having a higher liability on your books for a longer period of time. Mm-hmm. So I would imagine that most companies will choose to use their incremental borrowing rate when terminating that.
And we noticed we liked the discount rate so much that we put 2 slides in here on it. And we thought maybe this guy is just sitting there thinking about leases and
he's contemplating the FASB there.
yeah,
or he's deciding to jump off one of the two.
right.
I'd like to think, I want to view positive that he's contemplating the future of accounting, looking at that beautiful mountain range.
This next slide, it's probably a bit out of order. This is just the subsequent measurements, some points. So if you think back to year 2 or 3 on Jake's example, just kind of covers that, whether it's operating, goes back to the straight line, you adjust the liability and the right of use asset, and then you do what you do for finance lease, comparable current capital leases, you'll have interest, and then you'll amortize that ROU asset. So apologize for being out of order on that. Transition. Okay. So as written, the ASC had the modified retrospective approach, which required the transition adjustments for the 2 years before the effective date and to issue 2 years of comparatives. As Jake mentioned earlier, in March, we did get some relief on that and approved an optional transition method. Depending upon the status of where companies are, this may be very appealing. But basically, it allows companies to forego the comparative statements entirely, and the company would recognize cumulative effect adjustment to the opening balance or retained earnings on the effective date. And I want to point out that this only changes when the company has to apply the transition requirements. It doesn't change how they're applied. And again, companies will need to determine if they utilize this, they're not going to have comparative statements for a couple of years. So there's some cost and benefits to take into consideration.
Yeah, I think the one benefit that could be there, if you're a company that did a lot of renegotiation of your leases within the last 2 years and you have a lot of modifications, the ability to ignore those and not have to implement that a year ago or 2 years ago and just show it as it exists on January 1, 2019 might be a reason that you do that.
Covering some of the practical expedients, Jake mentioned use of the risk-free rate. The next 4 that are listed there, where it says may elect not to reassess, consider the first 3 at first. So the first 3 items, if these are elected, they have to be elected as a package and applied consistently to all leases. So a company may have a few leases that are, maybe they're super large and they do want to assess the impact. If they do that, then all leases get pulled in. So it's basically all of them or none of them. And again, with these 3 bullet points, you basically take it as a package or you leave it. And they are, the company does not need to reassess whether any expired or existing contracts are or contain leases. So if there's old contracts that a company's operating under, and they've already previously assessed whether or not there were leases as part under the old guidance, they don't need to go back and reassess those. Entities, they do not need to reassess the classification for any expired or existing leases. So old operating leases will be classified as operating leases and get moved over to the balance sheet. Old capital leases will continue to be accounted for as they were and be classified as a finance lease. And then lastly, company doesn't have to reassess initial direct costs for any existing leases. One thing that's not on there, I guess I want to point out, is that a company is allowed, obviously, to use hindsight if they are going to do some assessments. So they can use hindsight to determine the lease term and in assessing any impairment of the right of use assets. And then historical right-of-ways. This was a basically a big win, largely for our midstream friends out there. An entity can continue applying its current policy for land easements, which existed as of the effective date. And any modification, now keep in mind that any changes or modifications would then get corrected prospectively as we move forward.
And new agreements as well on the right-of-way. So you only get an exception for the historical right-of-ways. And this really was a concession to our industry who petitioned the FASB hard to get that. Some of our right-of-ways are, could be 80 years old and, handwritten on one sheet of paper. So the ability to continue to account for historical right-of-ways, as we always have done it, was a big win for our industry. So yeah, makes it a little bit easier.
So a couple more slides on at least this section, this part, real quick. Here's just a few random topics to consider, and really we could spend trainees could go on for quite some time on these items. So please do go read the ASUs regarding these items. And then the next slide is compliments of accounting research manager, I believe, and it kind of compares old GAAP and new GAAP. And you see the new model there on the left under 42. You have operating and finance, and then on the top there under the old, and you can see how the changes that have occurred. So feel free when these slides are emailed out afterwards to leverage that.
Okay, next polling question, Emily.
All right, our third question. What resources are you using for your company's implementation? Your options are current employees to do in between their normal duties, dedicated team, outsourcing to a third party, or undecided. And I'll give everyone a few moments to make a selection. For those of you that would like a copy of today's slide deck, you can download that now from the folder that says Slide Deck and Handouts to the right of the slide view. And we'll also be sending an email after the webcast with a link to download the slides. I'll give everyone a few more moments. And let's take a look at the results. Back to you.
Yeah, so most of the people here are saying current employees to do most of the work in between normal duties. So I appreciate how hard that is, as auditors who come in and ask you to provide us schedules on top of your normal duties, and then you did revenue recognition on top of your normal duties. Probably a lot of you 404 on top of your normal duties, and now we're going to do this. So I know it's hard, and we appreciate that. But I think that's probably likely true for most companies.
One thing I do want to mention is that I think it largely, especially for E&P, we saw that the revenue standard was not as significantly impactful as it was in other industries. Leading up to it, there's a lot of concern as to how difficult it would be, how much it would affect, and really, as we got more into it and it became effective, there were definitely some considerations, some gross fee net considerations. We do want to caution that leases are really expected to take a good chunk of time to properly assess and account for these. So when considering companies' available resources and capacities and trying to thoroughly meet the effective date, something to consider.
All right. On drilling contracts, we've talked a little bit about this already, but it says some could be leases. I should have probably said I think most. Are going to be leases. Yeah. I think particularly the stronger E&P companies that have more wherewithal, more leverage with their suppliers and contractors. They want the new rig. They want the best crew. They want to control where that rig goes. The drilling sites I've sat on, the company's engineers are in there along with the owner of the rig's engineers, kind of joining and making decisions, or at least getting the input in there. But the final call really on where we're going to drill, how we're going to drill, where, which wells we're going to drill in what order remains with the company. And that, to me, sounds an awful lot like what I mentioned earlier on, where you are you have the right to control that asset throughout its term. The situations where you could end up where it's not in your control, I think would be probably a bit more unusual. Say you're drilling a bunch of shallow gas wells or something like that, and you don't care where they go, and they're all going to go to, 5,000 feet or whatever. Then maybe the operator is controlling it more than you are. But I think for most of our companies that are drilling long, complex horizontal wells in established plays and have the wherewithal to command some control, most of our drilling contracts, I think, are going to be in there. Things like day rate contracts, maybe not, but then you're making the major decisions, and maybe you can get out of it on a 12-month lease, but I think those are going to be highly questionable as well. All right, we got the next poll question here, I think the final poll question. And I think just a reminder, we've got to get 3 out of the 4 poll questions to get CPE. So if you missed one, make sure you pick this one up.
Yep, this is our last question. Is your company implementing or planning to implement new software to track leases? Yes, no, or I don't know. Once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. Give everyone a few more moments for this last poll. And let's take a look at the results. Back to you.
Yeah, I think that's another good question, if we're going to use software or not. Obviously, you start looking at that Excel spreadsheet that I presented and explaining that, it might lean some of you guys more towards considering software rather than not, and I think there's been a lot of developments out there as well. Okay. I think, continuing on with drilling contracts, there's a few other ideas. A turnkey contract, there's some considerations to consider there. And even if otherwise, that last bullet point, you get, to the point where maybe you think it's an operating lease, then I think you still have to look at, some questions with the regulatory authorities, what would happen if there was a blowout, a spill, et cetera, and who would have obligations and things like that. And I think those might push you back into the financing lease as well. So, or at least considering it a rate, considering it a lease. I'm going to skip to this next slide and let Matt take over talking a little bit about transportation and storage.
Yeah, and I think looks like we're getting close to the top of the hour. We're going to try to get through these and answer any questions. Keep in mind, if we don't, if we run out of time for questions, we do have them all. We can see some handful of them coming in, and we do have contact information. So offline, Jake and I will work to provide answers and send those to the askers directly. Jake touched on pipelines previously, high level. Really, it's transportation contracts, storage contracts may fall in the scope of the new standard. Consider do they involve an identified asset, and does the customer control the use of it? In those situations where we've contracted, an E&P is contracted with midstream and is using essentially 100% of the capacity, let's say of a gas pipeline, we do believe that this will be considered a lease of the pipeline because they control the inputs and they control what goes in and what comes out. Now, while the midstream company will operate and keep up repairs and stuff, it's really about the E&P company is receiving the economic benefit of having that pipeline and having 100% capacity. In a situation where it only has, say, 25% capacity, it probably would not be considered a lease.
Yeah, so I think this, following up on that here, just some more things to consider with transportation type contracts. Essentially go back to that overall definition. If you control the vast majority or substantially all of the input through any kind of gathering system, it's probably going to be your lease. But once it gets to the main pipeline and you're just using a portion of that capacity, then it isn't. And that's probably the easiest way to decide how you're going to account for those things.
Mm-hmm. A lot of these contracts are going to come with service components. There is, the FASB has allowed companies to combine the lease and non-lease components, but consider rigs. The lease may apply to the rig, but not the service component, including the cost of the crew. As I mentioned, the supplier of a pipeline will operate facilities or pipelines, but again, you're allowed to combine those if you wish.
Yeah, I think that's going to be a big judgment call that I think a lot of people on this phone are going to have to make, because if you do have a joint rig that's going to account for as a lease, it's certainly going to be a lot easier just to take the money that you have to pay for the crew and everything else and put it together with the cost of the rig and record one number. But then obviously now you're going to have a higher liability on your balance sheet and a higher asset and increased impairment and the like. So this is one of the significant judgments I think is going to really come down to our industry, because the non-lease components are going to be a much greater amount of the total cost on a drilling contract than in other industries where the non-lease components are much smaller.
And we touched on the operator. Think of operator versus non-op. In most cases, like we mentioned here, we expect that these new right-of-use assets, the leases, will be reflected 100% on the operator's books. They're the ones who contract with the vendors. We can't, unless there are subleases, which are included as part of the joint operating agreement. We kind of expect those to be more rare. But if there are, then a non-op would have to, they would obviously be party to a sublease and would look at that in order to properly account for the lease. Consider the rights and obligations and such.
Yeah. I think that was our last slide, and Emily will start letting you ask us some questions, and I'll try to get through as many of these as we can here in the last few minutes.
All right. Our first question is, can right-of-use asset be included as part of oil and gas properties?
I think Jake highlighted that earlier, and the answer is largely no. We believe it's a separate asset. It's not part of your oil and gas properties, which are proportionately consolidated. Now, we can see potential situations where instead of recording a lease expense when those payments are made, that expense may be capitalized depending upon the circumstances as part of oil and gas properties.
All right. Do you have any thoughts on best practices for identifying embedded leases?
Yeah, I think, getting multiple groups involved, I think is going to be important here. I think, engineering and procurement type people involved and looking at the contract, setting out a team, a multidisciplinary team, and don't just leave this to the accounting department to figure out. Get operations involved, get treasury involved, get accounting involved, and probably even some people doing your SOX 404 involved. And I think really making sure everyone knows what a lease definition is, and that, just because it doesn't say lease on the top of the document does not mean it's not going to be a lease underneath this, standard. And so I think the more we can educate those people, the better. At least that might help them when they're structuring a contract to know if something could be a lease and it's going to get recorded or otherwise it won't. A couple other questions that I've seen here come through. Do minimum lease payments cover the base rent, or should operating expenses, CAMs, be included? So in general, it's just the base rent. There's a provision, a couple of provisions that talk about variable payments, and if a variable payment normally would get excluded from the calculation of the right of use asset and the liability. But if you structured it, they really went a long way to try to avoid structuring. So if you structure it such that your variable payment really, in essence, is a fixed payment, like you're going to have to pay one way or the other, you're going to have to include that variable payment in your base rent. And then also any escalations that are tied to like a CPI or an index or something that's published like that, you take what it is now and then use that number to calculate out what the base rent's going to be. And a question on what happens to the direct indirect costs associated with the lease. They're clear that any indirect costs, like your internal employee costs, costs that you've incurred before you're researching to sign a lease or things like that, all that are going to have to get expensed. And then direct costs associated with acquiring the lease. Once you're in the process of actually getting that lease, those direct costs get added to the cost of the asset.
For non-operated interests, the company is insulated from leases entered into by the operator if the non-operator is not party to the contract. Is this correct?
That is correct.
Yes.
As long as, I think it's pretty rare. I've never really seen my non-operators jointly sign a drilling contract.
Yeah.
When you read the guidance out there, it sounds like that could happen, or maybe it does happen. So if you're not a party to the contract, then you don't have to record this lease on your books. So, really what's going to happen is the operator is going to have the whole lease on their books, and then as the drilling occurs, it's going to get billed through your JIBs, and you're going to, essentially decrease that right of use asset into oil and gas properties. If you think about it on a gross basis, putting it in there, and then on a net basis, taking back out what the non-ops portion of that is and recording that as a JIB receivable. So non-operators, you do get a break here on having to deal with most of these types of things. And I would suspect that it would be rare for a company to sign something like that with the provider. But if it does happen, then you might have like a sublease or a joint lease. Now you have the obligation and you owe it, and you're going to go ahead and record that. But I think for the vast majority of times, that's not going to happen. Okay, I think we're about out of time. There's a few questions here that we didn't get to answer, and we did get the contact information from people who sent those questions in, and we'll attempt to get back in touch with you guys and get those answered. So thank you very much. On the first slide was Matt's phone number and my phone number. Happy to talk to any of you guys at any time on questions on implementing this thing, and look forward to talking to you all soon. Thank you.
Thank you.
All right. Thank you, Jake and Matt, for a great presentation today. And as we mentioned, if you asked a question that we did not get to answer today, we'll be happy to follow up with you after the webcast, or you can reach out directly to Matt or Jake. Their email contact info is available in the speaker bio widget. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. And thank you for joining us today. We hope you'll join us again next time.